Alex Lennard, Investment Director at Ruffer Investment Management. Welcome.
Thank you for having me.
Alex, could you explain the Ruffer investment philosophy and approach to us?
Sure. So Ruffer, we take a very different approach to investment in that we invert the telescope. We've been around for 27 years now, and the very simple foundation that Jonathan Ruffer set this business up with was, as much as clients like making money, they hate losing it more. So the first investment objective that we operate with at Ruffer is to try and provide positive returns irrespective of what's going on in financial markets. And we think if we can do that, and importantly avoid losing money during the bad times, simply by being fully invested, we should be able to capture the risk premiums available in markets and make steady cash or inflation plus returns when times are good in markets. Ultimately trying to provide genuine protection for our clients during periods of stress and good returns when periods are less stressful.
One of the adjectives you use is unconstrained. What does that mean for Ruffer?
So by unconstrained, we mean we're unbenchmarked. So if we see an asset class as dangerous, we don't simply underweight it versus a strategic benchmark. We can avoid it in its entirety. It also gives us the flexibility to go wherever we see the most attractive returns available in markets. Now, implicitly, we do have a couple of constraints, which is to be liquid and to be transparent. Liquidity, because we want to be able to change our minds, and transparent, because we want clients to be able to understand why we're positioned the way we are.
So what does your universe of investment possibilities really look like? There must be some limits somewhere.
So global equities, global bonds, currencies to the extent we can find an asset class to express a currency view, and increasingly over the last decade or so, active use of derivatives to provide protection within portfolios.
So what role does risk management play, and how is that managed within the portfolio?
So a lot of investment approaches focus on putting as many return-seeking assets in their portfolio as possible, and then thinking about risk as an overlay, something that comes at the end of the process. The way that we think about risk comes right at the start of the process, in that first and foremost, we try to identify the risks that we see in the world and put in place the assets that we think will provide a positive return should those risks come to pass. We then spend the rest of our energies asking ourselves, what if we're wrong? What if those risks don't happen? Do we have enough growth assets in portfolios to enable us to carry that protection throughout the cycle? I think importantly, risk management is absolutely endogenous to everything that we do, rather than coming as an overlay function at the end of the process.
Describe the decision-making process.
So we think asset allocation is the predominant driver of our returns. Now, I focused a lot on the identification of risks and avoiding losses. So the starting point from our process is to identify the risks that we see in the world, and then putting in place the assets that we think will deliver a positive return should those risks come to pass. But then, because we have the privilege of being unconstrained and global and multi-asset, we acknowledge however big we might perceive the risks to be, there will always be opportunities to drive returns. So having that asset allocation approach that balances the amount of protection and growth assets in the portfolio at all times, and then having a dedicated research team filling both of those buckets with the best expressions of the macro asset allocation views of the world, is ultimately the driver of the process.
What are some of the areas that have emerged onto your radar screen in recent years where you can find meaningful non-correlation?
In short, we think you have to pay for it at the moment. If you think the last 40 years has been characterised by owning assets and putting a bit of bonds in the portfolio as well, we think that's the antithesis of the world that's coming, and you're going to need to pay for protection into your portfolios. Because ultimately we think we're in the midst of probably the biggest regime shift you've seen in financial markets for a generation. Moving out of a low and stable inflation regime, moving into one that's going to be characterised by structurally rising but more volatile levels of inflation. Importantly, this is a threat to the asset owner, being a transfer of wealth from the saver to the borrower. So protecting clients against that new inflationary regime, both through using derivatives and having an allocation to liquid real assets, is fundamental to how we're constructing portfolios.
Alex Lennard, thanks very much for your time.
Thank you very much, James.